Welcome to vTalkInsight, Market Drivers Daily for July 14th, 2026. Energy, rates, and AI are colliding today as oil spikes toward recent highs. Bond markets rapidly reprice rate expectations, and the AI buildout raises new questions about earnings and power supply. Let's start with the energy shock that is setting the tone across assets. Energy markets are trading around a higher risk premium as the Strait of Hormuz shifts from a bottleneck to a potential fault line for supply. U.S. naval blockades, a newly imposed 20% fee on cargo transiting the route, and attacks on Gulf shipping have pushed Brent toward the mid to high 80s, with some moves approaching $90 a barrel. Shipping traffic has slowed sharply, and that structural disruption is now embedding itself in oil pricing. The pressure is not just on crude. Russian diesel export bans after refinery attacks, Ukrainian strikes on Russian refineries, and U.S. refinery utilization near 96% are keeping diesel, gasoline, and jet fuel markets tight. China is holding back spare refining capacity. European gas futures have jumped from the 40s into a 50 handle, and attacks on cargo ships are spilling over into agricultural prices such as wheat. For inflation, this energy shock is a complicating overlay rather than a clean new regime. UK inflation is expected to fall back toward 3% as early as July, but the next 6 to 9 months hinge heavily on oil and gas prices. Middle East disruptions are seen keeping U.S. inflation elevated in the short term, yet not enough on their own to force a recession or a radical break in the macro environment. European bond markets are already reacting to this energy-driven risk. Rising oil has lifted inflation expectations and nudged European yields higher, with Italian government bond yields up and UK gilts underperforming global peers. Traders are now pricing in 2 additional Bank of England hikes by year-end, reversing earlier talk of cuts and underlining how vulnerable the UK is perceived to be to geopolitically driven energy shocks. In equities, sector and regional rotation are telling the same story. European indices are under broad pressure, with more than 3/4 of the stock's 600 trading lower, even as energy and basic resources outperform. Higher oil around $85 is boosting energy names while weighing on European luxury, travel, airline, and hotel stocks, and corporates with heavy natural gas exposure remain especially vulnerable to further supply disruptions. China's recent 41% drop in crude imports has helped cap prices for now, but any rebound in its demand could quickly test this fragile balance. All of this energy uncertainty feeds directly into the next driver: how central banks navigate inflation and rates. The rate story is increasingly being written by energy and supply shocks layered on top of resilient demand. Rising oil prices and renewed geopolitical tension have pushed traders to ramp up bets on a July Federal Reserve hike, with 2-year Treasury yields rising toward 4.3% and markets treating a move as highly likely unless incoming consumer price data surprises to the downside. Fed officials are leaning hard into a data-dependent narrative. Governor Waller and others have warned that another strong core inflation reading, or a broadening of price pressures, could justify renewed tightening, even as the latest projections still show only 1 additional hike this year, and inflation drifting toward roughly 3.3% by year-end. Officials stress patience, but also keep the option of acting quickly if inflation expectations begin to slip. That communication backdrop is colliding with already elevated yields. 10-year Treasuries are trading around 4.6%, with 30-year yields above 5%, and some moves earlier had 10-year yields approaching 5%. Several commentators argue that current bond pricing does not yet fully compensate for ongoing inflation shocks, hinting that yields may need to stay higher for longer as the macro regime diverges from the unusually low rate environment of the 2010s. The UK and Europe add another layer of complexity. UK gilt underperformance, driven in part by fears that geopolitical energy shocks will bite harder there, has seen markets move from expecting potential cuts to pricing 2 more Bank of England hikes. Across Europe, higher oil is lifting inflation expectations and government bond yields, with Italian spreads edging wider, even as German yields remain relatively stable. There is, however, a counterweight to this hawkish tilt. Some analyses suggest the U.S. economy can absorb energy shocks without triggering persistent inflation, especially given earlier disinflation helped by lower gasoline prices. Recent guidance from the Fed also emphasizes a willingness to pause if inflation decelerates, and markets are still debating whether expectations for multiple cuts have simply normalized to a higher-for-longer path rather than a fresh hiking cycle. The key watch points now are upcoming CPI and producer price data, Chair Powell's testimony, and how far central banks allow bond yields to tighten financial conditions before stepping back. Those same forces are also shaping the AI theme, where heavy investment and changing business models interact directly with the rates backdrop. The AI story remains powerful, but it is no longer a simple growth narrative. The scale of infrastructure spending is unprecedented, with some projections suggesting hyperscalers could account for up to 10% of the investment-grade credit market by year-end. Investor focus has shifted firmly toward compute, memory, and data center buildout, benefiting names such as NVIDIA, SK Hynix, and Micron, and reinforcing a tilt toward hardware over traditional software. Semiconductor stocks are again at the center of the theme. AMD, SK Hynix, Micron, and other U.S. tech names are rebounding, supported by analyst upgrades on robust data center demand and expectations that AMD's AI-related units could grow more than 50% next year. South Korea's market has become a key barometer after sharp swings in SK Hynix, underscoring how AI-sensitive chipmakers now trade like high-beta macro proxies. Beneath the surface, though, business model risks are rising. AI-related capital spending is scattered across different operating expense lines, making it difficult to gauge true investment scale from standard disclosures, and some enterprises may discover untracked usage of high-priced models that leads to earnings surprises. At the same time, model pricing is collapsing from levels above $50 per million tokens to around 50 cents, while performance gaps narrow, threatening the premium once enjoyed by top-tier providers. The debate over where AI runs is also intensifying. Advances in compressed, on-device models suggest that phones and wearables could handle more workloads locally, sharply reducing memory and graphics processor needs, and calling into question some of the more aggressive bullish assumptions for data center chips. Apple, amid a leadership transition, is betting heavily on local models and plans a suite of AI-enabled hardware, from smart glasses to new AirPods and home devices, to anchor its next hardware-driven growth phase. Infrastructure and power constraints round out the picture. PJM, the largest U.S. grid operator, recently failed to procure enough future electricity supply, highlighting how AI data centers are straining capacity, while Bitcoin miners are repurposing facilities to serve AI workloads as both sectors chase cheap, often renewable, power. Banks are focusing on cost-effective AI deployment to improve efficiency over the next 12 to 18 months, even as record trading and deal-making revenues are being supported partly by AI-related volatility and capital raising. Across all of this, the AI investment boom provides an economic tailwind that could complicate central banks' efforts to cool inflation, linking the theme directly back to today's energy and rates dynamics. To sum up, energy markets are embedding a higher and more persistent risk premium as tensions around the Strait of Hormuz, refined product shortages, and gas price spikes filter through into inflation and sector performance, leaving Europe and energy-intensive industries particularly exposed. Bond markets are repricing this shock into higher yields and greater odds of near-term rate hikes, especially in the U.S. and U.K., while still weighing the possibility that resilient growth and a soft landing allow central banks to move more cautiously. Meanwhile, the AI buildout is reshaping credit, semiconductors, and power infrastructure, with massive capex, rapid price compression, and evolving business models creating both opportunity and execution risk that feed back into the broader macro narrative. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.